Hello, my name's Gary Stafford and I'm Technical Director of Investment Data Services, and I've been investigating the works of W.D.Gann for all my working life basically. I've tried most technical analysis systems, which after trying them, most of them, in fact all of them, I reckon there's only really one that makes you any money, and it's the works of W.D.Gann. Some of you may never have heard of W.D.Gann, some of you will have done. If you haven't, there's lots of things on the website which will explain some things about Gann, but basically it was around in the he was born in the late 1800s, and I think he died in the 1950s, and he was regarded a bit of a guru on the markets, and basically everything he did was based on mathematics regarding the speculative markets. The techniques I'm going to show you, I'm going to show you on some indices, but basically they work on anything: currencies, index futures, individual shares. Everything works basically the same way, and I'm really just trying to get you interested. And I'm going to show you one of, well, probably the easiest to understand of Gann's rules, which are called percentages. Now, if we just read from Gann's book, he says, "One of the greatest discoveries I ever made was how to figure the percentages of high and low prices on the averages and individual stocks. The percentages of extreme high and extreme low level indicate future resistance levels." And then a little further on, he goes and says, "The most important resistance level is 50% of any high or low price." Now, a word of warning first of all, the market does not always stop at 50%, and the ability to make money is knowing when it's going to work at 50% and when it's not going to work at 50%. Obviously I'm going to keep that to myself unless you become a client, but I'm going to show you some examples of using Gann's 50% rule. Now, where did Gann actually get this rule from? Well, what I've done here is I've shown you the Dow Jones Industrial, and this is the only thing I really I've got the history that goes back as far as when Gann was around, and what you're looking at here is the Wall Street crash. So this was the top of the market in September 1929. This is the famous first part of the Wall Street crash, where it had a very severe fall going down. And then you probably won't realise, but there was actually a big rally after the initial part of the Wall Street crash, up from the major fall up to here, and then the real killer happened, the slow kind of winding down, where the real money was really lost. The first part of the crash really was, unless you bought at the top, was really all your profits disappearing, and then the rest of it was just losing all your money. And in fact the market actually fell 90% of its value, and bottomed out here, which was in 1932. So we're going to try and use Gann's percentage rules here, 50%, and see what happens. Okay, now obviously I wouldn't know that that was the all-time high at the time, but what I would do to any potential high is just take away 50%. Now, things don't fall 50% very often, and I'm not saying it's going to fall 50%, I'm saying the magical word, if it falls 50%. So if I'm up to about here, I just assume it may be the all-time high. It might not be, but if it is, I'd be very interested to buy it if it fell 50%. So what I'm going to do is take away 50% from that high. And how far did the first part of the Wall Street crash fall? It fell 50%, to give you the bottom. And the reason it went up there was because it was 50%. I know it's hard to believe, but that's the reason. The market then has a substantial rally over roughly about a year. So if we go to that low, we'd add to that low 50%, which would be an area where you'd be looking for the market to top out. And the market rose 50%. So you can see straight away where he might have got this idea that 50% was quite an important level to look for resistance. Now, the only other time since then, well, not in the 30s and 40s, where the market has fallen 50%, is as follows. Now, I've moved forward, and there was a major high made in 1937. But again, without the benefit of hindsight, you don't know it's a major high, do you? This was the low in 1932 that I showed you on the other graph. So from any potential high, you would take away 50%. So just in a quick example to show you it doesn't always fall 50%, let's say that we thought that was a major high there. I would automatically take away 50%. I'm not saying it's ever going to get there. Again, it's that magical word if. Now, it never got there, so it didn't fall 50%, so there wasn't a major buying opportunity. So if you can imagine, I'm always doing this. I am always taking away 50% from any potential high. There was another potential high here. Now, I might have only started doing Gann for the very first time here. Okay, so I can see that there's a potential high made here. So I would just automatically take away from that high Gann's most important percentage, which is 50%. So this high was made in 1937. So what we're going to do now is scroll forward. And again, it's not a prediction. I'm not saying it will happen. I'm saying if it happens. And what day will I know it's happened? The day it actually gets there. And it actually got there here. So at that moment there, the market had fallen 50%. So that is a point where you'd expect resistance. And if we scroll forward, you'll see it will happen to be a major low, and the market goes shooting up from it. So you can see the importance of 50% and why Gann might have come to the conclusion that 50% was an important level for resistance. What we're going to do now is look at the British market up to date and just show you how that would have helped you, that one particular rule, if not losing a lot of money, making some money. So and actually trades that I actually made. So we're going to go and look at the FTSE 100 index and the other British indexes.